Most people don't lose money in Bitcoin because the protocol fails. They lose because they fail themselves. This video is for those who are new to Bitcoin, still learning the ropes. But even if you're a veteran, consider it a reminder, because after 15 years of Bitcoin, I've seen one thing clearly. The mistakes never change, only the faces do. So let's break down the 5 biggest Bitcoin mistakes that can cost you everything and how you can avoid them. And if you find value in this, hit like, subscribe, and join the climb, because Bitcoin doesn't wait. Newcomers often think, I'll buy Bitcoin when the price dips lower. They wait for the perfect entry, as if the market will kindly schedule it for them. But Bitcoin doesn't play that game. Its path has always been brutal, sharp rallies, brutal crashes, long stretches of silence, and then another surprise. Look back, after the mania of 2017, Bitcoin didn't level off politely. It collapsed into December 2018, bottoming near $3,100. In March 2020, on Black Thursday, panic gripped every market and Bitcoin wicked down close to $3,900 before bouncing. Fast forward to November 2021, an all-time high of nearly $69,000, followed by another deep drawdown, this time into $15,500 by late 2022. Then came the rebound. March 2024 broke new highs above 69,000, and by summer 2025, Bitcoin touched roughly 124,000. Today, as of September 2025, it trades around 111,000. And here's the point. Nobody, not me, not Wall Street, not you, could have timed those exact swings. People kept waiting for the real dip. Many missed the only chance that truly mattered, simply being in. The real risk is not buying at the wrong time. The real risk is not buying at all. If you buy and price falls 20%, yes, it stings. But if you wait endlessly and price doubles or triples, you lose something you'll never recover. Time. That's why the only approach that works, cycle after cycle, is consistency. It's called dollar cost averaging, DCA. Small steady buys over weeks and months. It takes the guesswork out and replaces it with discipline. Think about it this way. Traders chase charts, convinced the next candle will make them rich. Hodlers quietly stack and sleep. 5 years later, the result isn't even close. The traders burn out. The hodlers own Bitcoin. Timing the market always beats timing the market every single time. So if you're still standing at the station waiting for the perfect train, let me save you the suspense. It's already gone. But the next one is boarding, and the doors are open. All you have to do is step on. The second mistake is treating Bitcoin like a lottery ticket instead of what it truly is, a savings technology. Too many people enter with the right idea, buy Bitcoin, hold it, escape the slow bleed of fiat. But then the casino lights start flashing. Altcoins promise faster gains. Leverage promises bigger gains. Yield platforms promise easy gains. And soon enough, Bitcoin becomes the thing they should hold. But don't. I've watched this play out every cycle. 2017, people ditched their Bitcoin for ICO tokens. 2021, the same story, only with DeFi NFTs and dog coins. And each time the ending is identical. The majority lost their stack. Why? Because markets punish impatience. Altcoins pump hard and then collapse harder. Leverage rewards you once and then takes everything back. And yield platforms, they pay you 8% interest until the day they vanish, with 100% of your coins. Here's a story I've seen too often. A newcomer doubles their stack in a single month using leverage. They feel like a genius. The next month, they get liquidated and walk away with nothing. That's not investing. That's gambling with worse odds than a slot machine. Bitcoin, on the other hand, is not about trying to outsmart the market. It's about outlasting everyone else. When you gamble, you think short-term, this week, this month, this trade. When you stack and hold Bitcoin, you think long-term, this halving, this decade, this lifetime. It's the difference between sprinting until you collapse and simply walking steadily uphill. One ends fast, the other gets you to the summit. And let's be honest, the illusion of getting rich quick is powerful. Everyone wants the shortcut, but in Bitcoin, the shortcut is the long road. The ones who simply bought, held, and did nothing are the ones who won. So here's the rule. If you treat Bitcoin like a casino chip, you'll eventually hand it back to the house. If you treat it like a once-in-history monetary asset, you'll preserve it. You don't need clever trades. You don't need 10 monitors and caffeine at 3 a.m. You just need conviction, patience, and the humility to admit you cannot outsmart Bitcoin. Stack it, hold it, forget it. That's not boring. That's freedom, because in this game, survival is the real alpha. fear and greed. They are older than markets themselves, and in Bitcoin they destroy more stacks than any hack or scam ever could. Fear makes you sell in the crash. Greed makes you buy the very top, and together they keep countless people poor in an asset designed to make them free. I've watched it play out every cycle. In 2017, as Bitcoin fell from nearly $20,000 to $6,000 in a matter of weeks, panic selling was everywhere. Many sold at the bottom, convinced Bitcoin was dead. In March 2020, on Black Thursday, fear gripped the world as Bitcoin wicked down to under $4,000. People who had sworn they'd never sell suddenly did at the worst possible moment. Then in 2021, the opposite force took over: greed. Everyone was piling in at $60,000 and above, convinced the only way was up. That was weeks before the cycle topped. Here's the lesson. If your emotions drive your decisions, the market will use them against you. Bitcoin doesn't care about your feelings. It doesn't care if you panic or if you FOMO. It just keeps producing blocks every 10 minutes, like clockwork, and yet every dip feels like the end of the world, and every rally feels like a once-in-a-lifetime chance. That's psychology, not reality. The antidote is perspective. Zoom out. A monthly chart tells you what a 5-minute chart never can. Bitcoin has always recovered, and it has always set new highs. The only people who lose permanently are those who panic sell and never buy back. I've seen two kinds of people in every crash: those who say, "I can't take this anymore, I'm out," and those who quietly keep stacking even as blood runs in the streets. 5 years later, the difference is night and day. Here's the truth. You will feel fear. You will feel greed. The difference is whether you act on it. Practical rule: if you feel panic, do nothing. Step away, sleep on it. If you feel euphoria, do nothing. Remind yourself, trees don't grow to the sky. Discipline means protecting yourself from yourself. That's what separates a gambler from a hodler, a tourist from an OG. Because Bitcoin rewards those who can detach from the noise, who can survive the fear, who can ignore the greed. If you can't master your emotions, you will lose your Bitcoin. One bad decision at a time. But if you can, you'll find that conviction is the strongest currency in this game. The fourth mistake isn't about price charts or bad timing. It's about something far more permanent: losing your Bitcoin because you never held your own keys. We've seen this tragedy play out again and again. 2014, Mt. Gox. Hundreds of thousands of coins vanished when the biggest exchange of its day collapsed. 2022, Celsius, FTX, BlockFi, platforms that looked too big to fail, evaporated overnight. Users were locked out, withdrawals frozen, balances gone. And yet, each cycle, new investors repeat the same error, trusting someone else with the one thing Bitcoin was built to protect: sovereignty. The rule is simple. It's as old as Bitcoin itself: not your keys, not your coins. When you leave Bitcoin on an exchange, it isn't really yours. It's a promise, a number on a screen. And promises can vanish. Exchanges can freeze withdrawals. Governments can pressure companies. Hackers can break in. Insolvency can wipe it all away. But when you hold your own keys, that dynamic changes. You're no longer a creditor, you're the owner. Self-custody isn't glamorous, but it's freedom. It means using a hardware wallet, writing down your seed phrase, backing it up securely offline. It means accepting the responsibility that comes with holding something that cannot be reversed or reissued. Some people say, that sounds scary. What if I lose my seed? But here's the reality. You're already taking that risk if you trust an exchange. Except there, you aren't in control. You've outsourced the risk to someone who doesn't care about your future. Bitcoin was designed for sovereignty, for resilience, for a world where you don't need to ask permission, but you only inherit those qualities if you actually take custody. Think of it this way: exchanges are for trading. But Bitcoin is not for trading, it's for holding. When people leave coins on platforms hoping for convenience, they are effectively saying, "I'd rather trust strangers with my life savings than take responsibility myself." That's not sovereignty, that's abdication. The market doesn't forgive that mistake. Ask anyone who had funds on FTX. Their coins didn't go down in value. They simply vanished. So, here's the choice. Do you want to own Bitcoin, or do you want to own a receipt that may or may not mean anything tomorrow? The moment you buy, withdraw. Send it to your wallet. Guard it as if it were gold bars in your vault. Because that's exactly what it is. Sovereignty is the whole point. Don't give it away. The fifth mistake is trusting the wrong people and the wrong platforms. Bitcoin itself has never been hacked. The protocol is solid, battle-tested, unbreakable in practice, but the weakest link has always been the same. Humans, companies, promises. Every cycle, the scams take a new shape. In one era, it was shady exchanges with fake volumes. In another, it was cloud mining contracts that promised steady yield but delivered nothing. More recently, it's been earn programs offering you 5%, 8%, even 12% yield on your Bitcoin. The pitch never changes. Don't just let your Bitcoin sit there, put it to work, and people fall for it again and again. Here's the reality. 8% yield can cost you 100% of your stack. Ask the people who trusted Celsius. Ask the people who left coins on BlockFi. The story always ends the same way: withdrawals frozen, bankruptcy filings, and customers left with scraps. But it doesn't stop there. Fake mobile apps appear on app stores, looking professional, but built to drain your coins. Advisors who DM you promising guaranteed profits. Ponzi schemes dressed up as fintech innovation. The danger isn't that these scams exist. The danger is that people think they're immune. The moment you say, "I'd never fall for that," you're already vulnerable, because scams evolve. They prey on your trust, your greed, or your laziness. So how do you protect yourself? First, keep it boring. Buy only on reputable exchanges. The ones with real regulation and history, and even then, treat them as a shop and not a vault. You buy there, then you withdraw. Second, remember this rule. If it sounds too good to be true, it always is. Nobody in the world can pay you risk-free yield on Bitcoin. Anyone who claims they can is lying to you, or using your coins for something you would never agree to if you knew the truth. Third, verify everything. Don't download apps from random links. Don't trust the person in your DMs. Don't believe a screenshot of profits. In Bitcoin, skepticism is not cynicism. It's survival. Because here's the harsh lesson. Bitcoin protects you from monetary debasement. It doesn't protect you from human stupidity. That part is on you. Trusting the wrong platform is the fastest way to turn sound money into no money, so don't outsource your responsibility. Be boring, be skeptical, be sovereign. That's how you keep what you've worked for. So here's the bottom line. Bitcoin won't fail you, but your own mistakes might. Avoid these 5 traps and you're already ahead of 90% of newcomers. Stay patient, stay sovereign, and stack with clarity. I'm the AlpineHodler. Subscribe and join the climb, because Bitcoin doesn't wait.